Hello, everybody, and welcome to the Dash Trader Newsroom. What were the markets looking for from the Fed? We had a bit of a big sell-off over the last couple of days. My name is Michael DeJoy, Director of Educational Services here at Dash Trader, joined by my co-host, Jill Molandrino. Jill, how are you?
Good, doing well. Good to see you again, Mike.
Fantastic. Well, let's jump right in. We had a lot of action in the markets the last couple of days. So the Fed cut rates by 1/4 of a basis point, but triggers heavy selling because it indicated that fewer rate reductions are expected ahead. Jill, what were the markets expecting?
It's so interesting, Mike, when the market was expecting 6 to 7 rate cuts last December and it didn't get it, you saw the performance of S&P prior to the sell-off yesterday, up 28%, the Nasdaq up 33%. The market fared quite well.
Yeah.
I think perhaps this was a gut reaction for a number of reasons. One, a lot of exuberance has been priced into the market now that the election has removed some uncertainty from the market. There's the perception out there that it will be a more business-friendly environment, tax cuts, digital asset, proactive and so forth. So there's a lot that's baked in there. So, you know, I it's not surprising to me that they're going to pause a little bit longer than expected. I thought that the expectation to 26, 27-ish was kind of on the table. If it's only 2 or 3 rate cuts in 2025, I really don't see how that's an issue. That suggests that the economy is still doing well enough on its own. Um, but again, these outsized moves, there's been such an enormous reaction to the top right of the chart that it's not surprising that the market is looking for some reason to shift money around or
Absolutely.
take some. And Mike, honestly, at the end of the day, where else? And I hate this phrase, like there is no alternative, but it's not necessarily Europe. There's no other region that has the setup like the U.S. does. Again, it's hard to tell what 2025 is going to look like with any administration turnover. It's not specific to Trump. I would say one of the tailwinds with Trump is he heavily benches his performance to the market, the economy, and America delivering leadership. And now digital assets is something else under that umbrella. I think the execution of these ideas and policies he wants to put forth, that is, the execution is the variable. So I think in my mind that perhaps in the near term might overshadow what the Fed is doing. So that's my thoughts around it.
Well, I mean, what you just said was execution, and we have this. The execution can possibly affect inflation. Inflation has been a persistent and ongoing problem for the entire Biden administration, and really the world since the pandemic. And the Fed has been very active in fighting inflation. The question is will inflation continue in 2025 or increase, or get worse? And really that has a lot of things that we're going to be talking about later when we talk about the wall of worry, the impact of tariffs and things of that nature. So certainly we see the Fed kind of setting themselves up for the future. And again, what you said as well with the market, I'm just going to go back one slide. When you look at the chart of the market, it's been up and away since August. So to correct a little bit is actually healthy and natural. So on that note, continuing in this vein, so the Dow Jones Industrial Average, as represented by the DIA here on this slide, had its worst 10-day losing streak since 1974. But again, we are also at all-time highs. So we know that the Fed inspired this sell-off a little bit, which was probably long overdue. The question I have for you is, and not just about whether or not to buy the dip, but what else do we have to worry about? Is this a buyable dip, or is it better to be a little bit cautious as we are going into the end of the year and we do have a lot of changes in store for January 2025. So what are your thoughts on this dip, and of course the possible yet again another government shutdown that's kind of looming as well?
Yeah, buy the dip has certainly been the mentality, and if recency bias serves its purpose, that's, kind of what investors have been getting used to. I think it would be certainly prudent to hedge. Obviously, that the opportunity was much more attractive before the sell-off yesterday when we saw the spike in the VIX.
Hmm.
There's also seasonality involved with it as well, right? The holiday surprise that we well, it's not really a surprise, Santa surprise, but we did see the positive market action in December, and then you do start to think about selling winners and losers as it makes sense for portfolio management. So I think that some investors will take advantage of, and again, Mike, I mean the sell-off, it's not like it was anything that extreme on a
Yeah,
percentage basis. I think the Dow is more concerning. Part of that because UNH is a Dow component, and we've seen the market
yeah,
cap destruction in that stock. So, I mean, using the Dow is, I feel like, from a media perspective, the numbers sound bigger just because of the way the index is
yeah,
constructed. But when you
absolutely.
take a step back, is it necessarily reflective of the drivers in the economy in 2024 and going into 2025, right? I think I'd
Yeah,
be more concerned about breadth broadening out. We've been waiting for the small caps to participate for I don't know how many years now.
hmm,
And they perform well for 2, 3 days and then they just kind of peter out. So um I think I would look to trade around if you are, a day trader, swing trader, the positions and the names that you know best that work well and have the best setups to the up or downside. You're just looking for the trading opportunity. And if you're a longer term investor, either look to add or hold on. I mean, as a longer term investor, imagine if you got out for 6 weeks from March to April in
right,
2020,
yeah,
that
crazy.
opportunity that was missed. So eliminate the noise. And as a trader, you don't need to be in every name. Go
Hmm.
with the stocks that doesn't be fundamental, but levels that you understand, trading patterns that you understand, and take advantage of the volatility.
Yes, absolutely. And one of the things I noticed before we jump into the wall of worry was I noticed that NVIDIA was already in correction territory. It was the hottest stock, in my opinion. It was one of the hottest stocks in 2024. It entered into correction territory, which is down 10%, and then sure enough, the markets were still pushing against the highs. And if you follow the leaders and you see that the leader was ready to take some profit, as did the rest of the market. And you start to see that the Dow started to correct a little bit, and the Nasdaq certainly corrected yesterday. So it's always a good idea to keep an eye on those leaders. Those stocks that have led the market up will also be the ones that lead them down. So going into our last wall of worry update for 2024, we have trade wars, potential trade wars, and the effect of tariffs. I'd love to hear your thoughts about the plan for tariffs and how that might affect inflation, because I've heard a lot on this. Next, we have obviously the government transition, which we've gotten pretty much a lot of the appointments kind of out of the way, but we have to see whether or not they are accepted or not. Potentially this is the start of a market correction, or maybe another market correction at some point in 2025. But I mean, I do remember us talking about a possible recession in 2025. Seems like we've kind of gotten out of that and kind of into soft landing territory. And then certainly there's the continued and ongoing tensions with China, Russia and Ukraine, Israel and the Middle East, and now to add to that, we have Syria, right, where the administration in Syria was toppled. So, and anything else. So feel free to jump in and talk on any of these points, Jill, that you see as something that we should be concerned with or monitor it going into 2025.
So trade wars, tariffs, government transition, that's kind of already lumped in, and we spoke about that. Market correction, we spoke about that. That's anyone's guess. It's market timing. Like I mentioned before, leverage the volatility when the opportunity presents itself. I would say, based on the conversations that we are having with macro strategists and economists, that tensions with China would probably be the biggest factor among this list of the wall of worry for a couple of reasons, right? So I think the world is going to follow because the EU, for all intents and purposes, kind of has its own issues going on and is really lacking in a
Mhm.
leadership position. So how it goes with the US policy and China policy and how we end up playing well the sandbox together is really going to dictate how geopolitical scenarios, market scenarios play out. I think those are two of the most if I had to pick everything on this list, the one that has the most snowball effect on other areas. Um, we do have a number of conflicts going on. These kind of just all popped up over the past 2 to 3 years. I don't know if a new administration coming in will, whether it's through diplomacy or other means, help to alleviate that. Hopefully, just diplomacy and deals will be the way that we work our way out of this. And I think that's somewhat manageable. But again, policy in the US, China, how that how we work together is really going to dictate how markets globally react to it.
Absolutely, absolutely. And the last question, and I know that you and I both like to follow cryptocurrencies, and it does seem like the Trump administration is very digital friendly in terms of digital currencies. What are your thoughts on cryptocurrencies and digital assets going into 2025 and the new administration?
So I've been pretty consistent on every media platform and in my academic work that getting constructive regulatory framework out of the US is the most important catalyst that the digital asset space will see. Um, and I spoke about this on a panel in Singapore. There could be frameworks in every other region of the world. Infrastructure could certainly be leapfrog, whether it's physical or digital, until you get an economy at scale with the innovation leadership that the US has. And again, I don't want to sound US centric. I don't want to sound narcissistic as an American. However, that the scale on virtually every metric and providing the framework around that is the catalyst that the market is looking for. Yes, it's great. We have product like spot ETFs. But Mike, I can't impress upon the audience that digital assets for nearly a couple billion people around the world, whether it's stable coins or other means of digital commerce cross-border, it is building local microeconomies. We are seeing alternative forms of capital formation taking place. And it is critical that I would prefer legislative or regulatory framework anyway, comes together because we don't want to lose that leadership position as global capital markets leaders in the world. Everybody wants to be in the US markets for a reason. But I think we need to start thinking about digital assets, not just Bitcoin and how it trades and how it hedges and what the
Mhm.
value
And what
is,
the price is, yeah.
because there are a number of digital assets that provide the underlying market infrastructure, which we all understand as equity traders. And we need to think about the ways that these technologies are being deployed to build out that infrastructure and build the next digital economy. So I think that narrative has to shift, and a regulatory framework is when you start to see like a real move off the starting line, in my opinion.
It makes a lot of sense. Well, thank you so much, Jill, and I want
Thanks
to
for
wish
you.
you a very happy holiday and a happy new year. And next time I see you, we'll be in 2025.
It certainly will be. All right. Happy New Year, everyone. Thank you for everything.
So we got a couple of minutes to the market close. Certainly, um, we talked about the Dow Jones Industrial Average. I'm just going to make this chart a little bit bigger. So let's take a look at a couple of different stocks. The one thing that I had mentioned, so here was the Dow Jones, pretty much for the year. This is for 2024. We have this big run up. And then, of course, if we draw in a trend line, we see we did get a trend line break on the kind of move up extension that we saw on the Dow. Now, obviously, you don't just get one trend line break. There was a newer trend line that was formed and that was broken there. So that was trend line break one, then kind of trend line break two. And then we've kind of come back down to horizontal support. Now let's take a look at NVDA, NVIDIA. like I had said earlier, we pretty much were in correction territory, which is 10% off your high. So if NVIDIA hit 150 and then it got down to 130, so from 150 minus $15, right? So that would be 50, 40, 35. So 135 was correction territory for NVIDIA. And certainly we have that leading the correction that started in the Nasdaq. Now we kind of squeezed up in the Nasdaq all year, so it's only expected that as you get towards the end of the year that you're going to get end of the year profit taking. You also have pretty much Meta up all year, right? This is Meta, formerly Facebook, up all year, profit taking at the end of the year. You got Goog finishing up near its all-time high at the end of the year after a gap up on earnings. Very, very expected profit taking. Okay. Let's go to MSFT. Not at the high of the year, but very close to it. You know, they kind of spiked a little bit earlier on in the year around June, July. So that's Microsoft, AAPL, Apple at the top of its chart, right? So Apple was pretty much staying in 2023 was staying at a 150 high area. But this year, the low of Apple was around 162, and really the high of the year at 255. Apple is just slightly off its highs, expected profit taking. So when you look, let's see Tesla, TSLA. Tesla, big breakout, big beneficiary, Elon Musk and Tesla, big beneficiary on how he bet with Donald Trump during the election. So every one of the major tech stocks is near its all-time high and really was just taking expected profit taking. Little different story when you go to ExxonMobil, a key component of the Dow Industrial Average. So you got UNH, right? Certainly UNH took it. Has taken a bit of a beating with the loss of its CEO, which is what we talked about a couple of weeks back. Needless to say, these are big components of the Dow, and that is certainly affecting the Dow composite overall. So I'm just going to bring back my my charts one more time and wrap things up. So we just finished up our market analysis. I did want to talk a little bit about gold. Gold has done very, very well this year as well. So, and I look at cryptocurrencies very similar to digital gold and digital silver, right? With Bitcoin being gold and Ethereum kind of being more like silver. But the as the gold, the top performing digital asset versus the secondary. Just like gold and silver, you should always keep a portion of your portfolio in gold and silver. I think cryptocurrencies have kind of gotten that kind of exposure as well. You need to have 5 to 7% of your portfolio to have in crypto in some way, shape, or form, because you don't want to miss out on that very, very explosively expanding asset class. So on that note, we're going to wrap things up and stay up to date with everything DAS by signing up for our monthly newsletter and email. Simply fill out the form at the bottom of our webpage at www.dastrader.com. Subscribe to our YouTube channel, Dash Trader TV, and our newsroom reminders. And certainly follow us on social media at LinkedIn, Twitter, Facebook, and Instagram. And I want to wish everybody a happy holiday as we close up for 2024. And I want to wish you nothing but the best in 2025 from myself and from everybody here at Dash Trader. Thank you very much.